From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, momentum in the U.S. labor market ebbs as hiring slows down sharply. Traders are now repricing to push out rate hikes as Fed Chair Kevin Warsh reaffirms his commitment to price stability. And the redemption caps continue. Blue Owl limits withdrawal requests for a second straight quarter. We begin with the big issue, a stable economic backdrop.
We're sitting in a labor market that's largely in balance.
The labor market's steady. This is not a collapse of the employment picture.
We're in this low hire, low fire economy.
I'm not really seeing the big buildup of systemic risk. What I see is a backdrop of exceptional, incredible nominal stability.
We do believe that we are in an environment where inflation is going to stay above target.
The inflation picture has gone the wrong way.
Well, if the economy's doing well and inflation's a little bit sticky, that fair value for interest rates is drifting higher.
The front end's telling you there's a hike this year.
This market has backed out all of the rate cuts and now maybe even pricing in a rate hike or maybe even two.
Our economists are expecting that we could see 3 rate hikes by the end of this year.
Our call is for the Fed to keep policy on hold for the remainder of the year.
We think they'll be looking to cut rates in 2027.
Kevin will watch the data and do what he thinks is right.
All right, our chart of the week is a glimpse at payrolls over the last 2+ years. And you see a lot of months in which we had additional job growth, only a few months in which we had job losses. But here's the latest print, 57,000. That comes on the heels of a blistering 3-month period in which we had a lot of job growth, and that has certainly slowed down. And that 57,000 is roughly half of the consensus estimate and much lower than the whisper number. Now, when you flip it up and take a look at how markets are interpreting that, in the rates market, there was a quick repricing, and we see traders pushing out the prospect of a rate hike. The 2-year yield plummeting, coming down and now off about 5 basis points at 4.12%. On Wednesday, central bankers from around the world spoke on a policy panel in Sintra, Portugal, and they talked about the thorn in all their sides, inflation.
We've all looked around and we've seen that prices are too high, and I don't think I'm the only one on this stage that's recommitted to deliver price stability.
I think risks, by the way, that we have to the upside on inflation and to the downside of growth are probably more broadly balanced than they were a few weeks ago.
It is very frustrating. I was very much of the view that we were going to have inflation back at the 2.0 targets.
There's a lot of uncertainty out there. Those risks could shift quickly. If the situation changes, we're prepared to take action.
Bloomberg's international economics and policy correspondent Michael McKee joins us now for more with chart in hand. So, Mike, does this latest jobs report kind of put the idea of the labor market back in focus from a Fed that was, it seemed, really squarely focused on inflation?
Not really, because what we saw is a big decline on the household side of 500,000 jobs in terms of employment and 720,000 people leaving the labor force. And a lot of economists think that basically that those are statistical quirks. It's an outlying number today. And so we really don't have to pay a whole lot of attention to it. The Fed is going to look more at the unemployment level, which fell to 4.2%. So they're seeing what they think is essentially full employment. What they do have to keep an eye on, though, is wages. Wages have been going down. Average hourly earnings have been going down over the last several months. And now they've bounced back just a little bit up to 3.5%. Now, the problem is it's not inflationary at this point, but eventually it could be inflation running ahead, as you can see, well ahead of what the average hourly earnings are. So Americans are kind of falling behind. Maybe this is more bad news for the president than for the Fed at the moment. But the yellow line there is showing what the markets are thinking, even though you mentioned the 2-year pushing out the idea of a rate hike to later in the year. That's the December chart right there. People are still looking for about 1.5 rate increases by the end of the year because they see still some inflation concerns underway.
So going forward, what data points, what economic data points now take on extra importance?
Well, it's obviously going to be the CPI because that's really the foundation for what everybody looks at in terms of inflation. It has the most detail. It's also the one that Americans pay attention to. The Fed, of course, looking at PCE, and they'll be looking at the PCE numbers in the services categories as well as goods, because at this point, that's where the stickiness is. And they want to see that start to come down. So look to the middle of the month for CPI, end of the month for PCE, and we'll see what the inflation story is.
All right, good stuff. Michael McKee, he will be back with us at the end of the program to join us and give us his thoughts on Kevin Warsh's new Fed. But in the meantime, let's dig into all of this with our macro roundtable. Michael Diczok is head of cross-asset market strategy for the Chief Investment Office within Bank of America. And we welcome Kelsey Berro. She is a fixed income portfolio manager at JPMorgan Asset Management. So let's talk first about the reaction in the rates market. I showed the 2-year yield chart a little bit earlier. Kelsey, what exactly is being priced out following this June jobs report, and what's needed for the front end to rally further?
Right. So the way I would describe this jobs report is a gentle reality check for the market. You know, the 188,000 3-month run rate on payrolls, which was what it was coming into this report, we were skeptical of that. It was probably too hot relative to reality. And now those 3-month and 6-month run rates have essentially come back to earth. And that risk that the Fed is going to need to hike in July has come down. But it doesn't solve the problems that the Fed has as it relates to inflation. And ultimately, that is why if you are looking for a further rally in the front end, as you asked, you would need to see sequential improvements in inflation to get that. And we may see some of that, particularly on the energy side. That's obviously where the low-hanging fruit is. Energy has come down, but also that will influence parts of core, like airfares, which is highly linked to jet fuel. And they're going to need to see that. And I think they're going to need to see more than one of those reports. So it doesn't surprise me that we still have 25 basis points of hikes priced in by year end, even after this report, which was a little bit softer.
All right, I'm looking at the dollar, the Bloomberg dollar index taking a big leg lower following the 8:30 a.m. release of the jobs report. Matt, when you look at the dollar and you think about how strong it's been, the strength that it's been seeing since the last, let's call it 4 weeks or 5 weeks, how does this jobs report, combined with what we're seeing overseas, what does that mean for the U.S. dollar and where it goes from here?
We continue to think we're going to see a little bit of U.S. dollar strength here.
A little bit, though.
A little bit. We think we're in the right zone. We've seen that uptick, as you pointed, in the dollar over the last couple of months. That is likely to stay. Again, at the end of the day, when you look around the world, there is no alternative to the U.S. dollar. It is the sovereign currency, not by default, but by choice. Actually, not by choice, but by default. Right? People need to use U.S. dollars as long as the rest of the world, for example, China, wants to lift themselves out of poverty. They have no choice but to export services and goods to the U.S., take those dollars, use those dollars. So our status as a reserve currency is fairly locked in. And again, we're doing as much as we can to try and reduce ourselves a reserve currency, but it can't stick. And so this slight strength we're seeing in the dollar, we expect to continue. We think it'll be range bound in this, but anything is slightly stronger and higher throughout the year, not weaker.
And of course, it very much always feels like the Fed is the central banker to the world. So when Kevin Warsh speaks, everyone pays attention. And he did speak this week. It's clear he doesn't want to offer any forward guidance. Kelsey, Kevin Warsh also wants a quieter Fed, less communication. Does that lead to more volatility and therefore opportunity for someone like you?
I think probably it does lead to a little bit more volatility. I think we really do need to see what happens with these 5 task forces that Chair Warsh has created, and in a way that creates a little bit of a runway where we're going to continue to do the things that we always did in the past, at least through the end of the year, which is going to give the task forces time to come up with new things. Essentially, you know, what I'm focused on is what is his framework. So I really caught on to this comment that Lagarde made in that same panel at Sintra, which is, we've given up on forward guidance, but we believe we still need to give framework guidance. I think that makes sense. Like, you want the market to understand how central banks are going to react to certain data, even if we don't have high visibility on what that next data print is going to be. And to be honest, we don't really have a sense of what Warsh's framework is yet. That's what we're still trying to understand.
Well, what we do know is that he doesn't want markets to spend their time trying to front run what they think the Fed's going going to do. Matt, is that a reasonable request? I mean, it's not like this is something new. This has always been the case where the bond market is trying to figure out what the Fed's going to do and price that in.
It's an absolutely reasonable request. Strategic ambiguity. That's what Warsh has is doing. He doesn't want to be telling the market what he's doing and then try to infer from the market what he should be doing. He's trying to take a step back, remove a little bit from central planning in the economy, and really letting the data drive markets, drive rates, with the economic growth. And then he, in his opinion, and I'm paraphrasing here, if he allows markets to determine the right level of rates, currencies, equity prices that are in the economy, then it's a useful signal. But I think he's a little bit circumspect in actually interfering with that signal and changing the data. And again, the Heisenberg uncertainty principle, you're getting, if you start looking at things too much, you affect them too much. So I think stepping back a little bit in terms of forward guidance is absolutely a defensible strategy and quite different from past Fed chairs. Not saying it's right or wrong, but it certainly is a defensible strategy that I think he can articulate quite clearly.
Okay, well, we'll see how it all plays out. Kelsey, there's so much corporate debt issuance, and I'm curious whether you worry that all this supply will eventually crowd out government bonds. After all, some big tech names have higher credit ratings, or at least similar credit ratings, as the U.S. government.
Yes, so we've seen a lot of issuance in the corporate market, and the real change in terms of the nature of that issuance is that it's coming more from the hyperscalers, which are higher quality in nature, at least relative to other parts of the market. What I want to focus on when you take a step back is, yes, those gross issuance numbers are very high, but when you look at them as a percent of the overall index, they're actually right on top of the 25-year average. So this issuance is large, but it's from a perspective of what is a very large market, the investment grade market. And then you have to look at both the supply, but also the demand. And we've been finding that at these higher yield levels, all-in yield levels, even if spreads are tight, demand is still generally there. Particularly, we see it in the flow data. And so while some deals are going to have more price discovery associated with them than others, we do think that there is a reason that some of those credit curves are steeper for some of these issuers because of maybe the longer term risk associated with the debt. We ultimately think that there is demand for these yield levels, and it's being fairly well absorbed in the market.
Okay, so not a threat necessarily to treasuries at the moment. Kelsey, thank you so much. Kelsey Berro of JPMorgan Asset Management and Matt Diczok of Bank of America. Really appreciate it. Still ahead, Blue Owl has been at the heart of the troubled private credit market and was hit with a record number of redemption requests for another quarter. Is the panic from Q1 still there? All that and more coming up. This is Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for a moment of interest. A pair of Blue Owl private credit funds hit with the industry's largest redemption requests, totaling $4.7 billion. And that has forced Blue Owl to cap withdrawals for a second straight quarter. Joining us now is Sinéad Cruz, a senior editor and author of the twice-weekly Going Private newsletter. So, Sinéad, which specific funds are these? Are they the large ones? Are they smaller ones? Just give us some context here.
Sure, yeah. Well, the numbers from Blue Owl Capital certainly got people talking this morning. It is one of their larger funds and a smaller fund indeed as well. First of all, the Blue Owl Credit Income Core, the larger of the funds, saw a smaller redemption request compared with last quarter. The same with their smaller Blue Owl Technology Income Core also had a number of requests to exit that fund. They're both exposed in a way to software, which is one of the key concerns of private credit investors at the moment.
Yeah, that makes a lot of sense. So it feels like a lot of this is spillover from the first quarter when they had to gate the fund and couldn't fulfill all the redemption requests. Is that right?
Yeah, that's right. But as I say, the numbers look quite bad. But if you take a closer look, there are still reasons to be optimistic that maybe the panic might be starting to subside. The larger of the funds saw $3.6 billion in dollars and cents requests, whereas the smaller funds saw 1.1. Now that compares with 4.2 and 1.2 from the previous quarter. So yeah, in a letter that Blue Owl sent to some of the shareholders today, they did give reasons for people to be optimistic about the future. And firstly, and most importantly, they pointed out that many of the investors who requested to pull their money were actually repeat requesters, people who had already asked to take their money out of those funds in the first 3 months of the year. Secondly, they're pointing out that actually their liquidity levels are pretty healthy. And at least in the larger of the funds, they won't need to sell considerable assets or even a single asset, as Craig Packer pointed out, a single loan asset from that fund to be able to meet some of the requests that were made.
I guess that would explain or help explain why Blue Owl shares are actually higher right now. The stock is up 4.6%. This idea that perhaps the worst is over and Blue Owl has found a way to kind of engage and get its message across to its investors.
Absolutely. I mean, they have been crisscrossing the globe in recent weeks to try and reinforce that message about private credit. Certainly, they are saying that their returns are still positive, that the asset class is still performing. And while there are headwinds, as there are headwinds facing many of the other fund managers within this asset class, lots of the questions about valuations and the future cannot be answered at this precise moment in time. So therefore, investors are choosing that maybe they should stick and see what the next few months brings.
Sinead, thank you so much. Sinead Cruz is senior editor at Bloomberg and author of the twice-weekly Going Private newsletter, a must-read for our Real Yield team. Now, still ahead, we've got our credit roundtable. We'll speak with Matt Brill, head of North American IG Credit at Invesco, and Winnie Cisar, global head of credit strategy at CreditSights. But before that, buy now, pay later companies are entering a new kind of agreement with private capital titans. Critics, however, worry that this arrangement could face risks as consumers show signs of strain. This is Real Yield. It's a quick check here on the markets. For those of you tracking equities, we're at session lows. The S&P and the Nasdaq down right now, with the Nasdaq off by 1%. Yields remain lower, especially at the short end of the curve. The two-year yield down 5 basis points at 4.122%. Now, in this week's Big Take, Bloomberg has learned that investment firms, including Blue Owl, KKR, and Elliott Investment, are now pre-purchasing billions of dollars of consumer loans from buy now, pay later companies. These deals are called forward flow agreements, and they're raising concerns. Rene Ismail co-authored the story, and he joins us now in studio. Rene, great to see you. I guess my first question is, why are all these firms purchasing buy now, pay later loans that haven't even been made, and who benefits from that?
Yeah, I think there are benefits on both sides. For the private credit firms, this is a great way for them to diversify away from your typical direct lending and move more into consumer credit, which a lot label as a growing asset class. I think on the buy now, pay later side, this is a really attractive way for them to move risk off of their books, which keeps them capital light. It helps them diversify their sources of funding, and that's really supportive for their growth.
Okay, so it sounds great right now, but this business model sounds similar to the lead up to the subprime mortgage crisis, where investors wanted to buy mortgages so that banks could keep originating mortgages to feed that beast. And it was this, I forget the technical term for it, but it just keeps going and going until something breaks. And it resulted in a lot of loans that probably shouldn't have been made in the end. And you're hearing similar things, right?
Yeah, absolutely. I mean, anytime you have any sort of financial institution that's originating these debts, packaging them up, and then moving it in and around the system, you're going to get parallels to the lead up to 2008. Yeah. But at the same time, you have to be very cognizant of scale. If you look at the mortgage market at that time, it was around $10 to $11 trillion. But if you look at just from a gross volume perspective, how big the BNPL space is, it's really only between 5 and 600 billion. So much smaller, much different scenario.
Okay, that's an important distinction. I think the word I was thinking of was flywheel effect. But what do ratings companies like Moody's think about this? Are they sounding concerned?
Yeah, I mean, I think you have to think about the risk in a couple layers. First, you have the scale, of course, but you also have this idea of cyclicality. In good times, it's very easy for private credit firms to step into these deals and arrange these transactions. But what happens when conditions get a bit choppier? Will they scale back? And because these buy now, pay later firms have so much capital to work with, they essentially get to become machines where they can just focus on scaling their own platforms and getting these loans into consumers' hands.
Now, we had, decent job growth. It certainly was a drop-off in June from the prior months, but the labor market is intact. Consumers, however, are under pressure with persistent inflation and living paycheck to paycheck. We hear about it from companies all the time. What are the buy now, pay later companies saying and showing when it comes to consumers being able to pay off their loans in time, service their debt, essentially?
Yeah, I think a lot of them are saying that non-payments continue to be manageable. And at the end of the day, the people that are using BNPL, and this is a really important part for us to think about, they skew lower income, they skew younger. And here's an interesting fact. Last year, 1 in 4 BNPL users used BNPL services to purchase groceries.
Wow.
Yeah.
That's probably not what it was intended for, given that initially it was like, hey, here's a way to buy a new outfit that you might not have thought about buying or planned to buy at this point. Rene, thank you so much. Rene Ismail covers private credit and leverage finance for us here at Bloomberg News. Coming up, we've got the auction block. The pace of U.S. high-grade sales this year has been red hot, over $1.17 trillion sold so far in 2026. That matches the historic peak set back during the pandemic in 2020. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the auction block, where we highlight the major credit issuance stories of the week. And this week capped off a record June for high-grade U.S. sales that saw $199 billion for issuance. Notable deals this week include Mizuho and SFMG. This is part of a trend as foreign currency bond sales by Japanese companies hit a record for any quarter. This surge in overseas currency deals is in part being fueled by the sliding yen as issuers lock in larger sums by swapping the money back into the Japanese currency. U.S. high yield also had strong supply, the group having the busiest second quarter since 2021, volume topping $99 billion, falling yet attractive yields and tight spreads spurring the wave of sales. And the superlatives don't end with the U.S. or Japan. Europe had a record June for total issuance. Those sales powering also a record for the first half of a year. Now, sticking with credit, Goldman Sachs' Amanda Lynham is anticipating a slight pullback.
We're seeing these kind of episodic periods of indigestion in the credit market. We're going to have a bit of a reprieve because we're in earnings blackout, so companies don't issue around the time of their quarter end and their earnings. So I feel like the market will pull back and tighten a little bit. But I think we should brace for periods and windows of heavy supply, especially subject to the whims of the market and sentiment. That there should be some more price discovery. And again, the point is this is a multi-year issuance cycle, not a small one.
Let's dig into all of this with our credit roundtable. Matt Brill, head of North American investment grade credit at Invesco and clearly a fan of Team USA, and Winnie, Cisar, global head of credit strategy at CreditSights. Probably a fan of Team USA, but just not decked out in the same way. Guys, thank you so much for joining us. I want to get to what Amanda had mentioned about this multi-year issuance cycle. I mean, we had near record investment grade issuance in the first half, $1.176 trillion, which is on par with the dash for cash seen during the 2020 COVID year. What does the second half look like when it comes to supply? Winnie, let me start with you.
Sure. Yes, we are seeing the convergence of, I think, 3 big themes in the IG issuance market, especially. You mentioned the big COVID issuance, and we're now seeing a lot of refinancing needs related to that issuance over the next 3 years, about $1 trillion of maturities annually. We're also, of course, seeing the robust issuance related to all things data centers, so not just the hyperscalers, but also utilities needing to fund the CapEx associated with building out the infrastructure and the grid. And then, of course, we've seen a nice uptick in M&A kind of in the large corporate space, which has also resulted in incremental supply. And when you put those 3 factors together, it does seem like the pace of issuance, so long as spread volatility remains low, is probably going to be pretty robust.
Matt, I know you travel a lot. You are in Atlanta right now. You talk to clients constantly. Where is demand growth coming from? By type, whether it's pension funds or insurance companies, and as well as by region?
So we're seeing tremendous demand institutionally right now, and it really is coming out of the pension plans. You look at pension funds, pension plans are about 108% funded, which means they're 8% overfunded. And we actually saw a little bit at the end of the quarter where you saw some rebalancing, taking out of the equity market, putting it back into the fixed income market to lock in these long-term liabilities that they have. So overall, the pension plans have been just a continuous source. The insurance companies love these all-in yields. They really don't care so much about spreads, but they're certainly aware of them. But the all-in yields are just tremendously attractive there. The area that we've been looking for a while is that the moving out of T-bill and chill and moving out the curve. And as the volatility has picked up and as thoughts that the Fed could actually hike has really kind of picked up, that's really sort of slowed the idea of wanting to invest from the retail market out the curve. So we're not seeing it in the retail space yet, but the institutional demand from pension plans and insurance companies have been more than enough to offset this supply.
Okay, plenty of demand, but then you look at what happens in the secondary market, the underperformance of SpaceX and NVIDIA there. Matt, I'm going to come to you again. How much more spread, how much higher of a yield premium do you now need to buy into the next tech deal?
Yeah, so I'm going to have to break out the red card for the SpaceX deal and how it performed. So very sloppy there. I don't know if it was a mistake on the bank's part or just the lack of demand from their traditional pension plans and insurance companies. But that deal has been really, really disappointing one. NVIDIA as well, but it was actually a much tighter spread there. So those deals have really shown the market that these hyperscalers, and NVIDIA is really kind of one of the new hyperscalers as well as SpaceX. There's almost 7 hyperscalers now. But these large borrowers for large CapEx projects have continued to flood the market, and they're pretty much price insensitive. They don't really care from a spread standpoint if they have to push the market another 25 wider in order to get their deal done, because to them, this is the greatest opportunity that they've ever had in their business lifetime. So we expect that to continue. And I think in the third quarter, you're probably going to see a surprise of 1 or 2 names that weren't even on our radar previously.
So, Winnie, in your notes, you've talked about how there's some pushback from equity and bond investors on this whole AI story, and we may even are starting to see the start of a negative narrative. In the worst case scenario, Winnie, how might this play out, and what kind of contagion effect might there be, if any?
I think that the number one thing to keep in mind in a worst case scenario, or at least a not great scenario, is the impact of the wealth effect on the U.S. consumer. We have seen tremendous appreciation of financial assets over the past few years, shaking off a lot of volatility, supported in part by all of the cash sitting in the front end of the curve, as Matt noted. And if we see a pullback on the equity side of things, then people are going to feel less flush with cash, especially that upper K of the consumer that has really been propelling the spending over the past few quarters. And if that were to actually start to manifest, then you start to see some of the pressure on margins, some more job losses, and that gets you into a pretty nasty consumer-driven spiral, which I think is what people are really worried about when it comes to talking about a true recession.
So it sounds like that might be big enough to kind of push the whole investment grade market wider. Is that right?
Yeah, definitely. That would be a bear case scenario in which IG spreads would widen out to levels that are starting to price in some downgrades, some fallen angel capital structures, higher probability of default, some recalibration of some of the very tight consumer names, and some of the more cyclical sectors that have benefited over the last few years.
Matt, you told our James Crombie last month that you take the approach that AI could be a complete flop and you're still going to get paid. So how do you get paid back, especially on the very long-dated bonds issued by tech companies to fund all their AI ambitions, the AI credit, essentially? What specifically do you buy to ensure that you get paid?
Yeah, so I was really speaking specifically to what we're doing, not just the market generically, because there will be obviously some losers. But what we're trying to do is address the structure of a lot of these one-off SPVs. So a lot of these companies are coming with the traditional vanilla unsecured, but they're also doing really unique special purpose vehicle projects, and some are backed by power, some are backed by chips, some are backed by other areas of the AI infrastructure. And the structure of these individual credits is tremendous. And this is like a really great bond pickers market to be taking advantage of this. You're getting some high yield names that have backing of Alphabet, and then at some point it'll go away. But the reality is these are going to get upgraded to investment grade in a lot of situations. So we really take kind of the what's the worst case scenario that can happen, because we don't get the upside that the equity investor gets. That's why why you have to be a little more careful in the long-dated unsecured. But the secured portion of the market, particularly in the structured credit market as well, is really attractive right now, and it just got to look through it on a case-by-case basis.
Matt, how much are you using tech credit default swaps to hedge?
So we're not using them right now. I'd say we're just really trying to not be overly concentrated within the tech space. There are multiple derivatives of tech that are going to benefit, but we think we can diversify with, which would be the industrial build out, your classic industrial companies, your power build out, which is your utilities, and then last, the banks that are going to be getting a lot of fees from the IPOs and the debt issuance of this. So we think that those are also a way to play this, but you just don't want to be all concentrated in tech. And if you were doing that, then you probably want to use more credit default swaps to hedge and wedge yourself.
I also want to get a final question into Winnie here on energy, because the energy sector has done really well because of rising oil prices. But now that oil has made a complete round trip back to where it was before the war started, I wonder how long energy junk credit can stay high with oil coming down. Is a fade inevitable, Winnie?
Yeah, we are definitely saying that it's time to lock in some of the gains that people have made in the high yield energy sector. It's been a massive outperformer this year, returning over 4% in the first 6 months of the year. Now spreads are very tight, sub 200 basis points for high yield energy in aggregate. And while it is not the sector of 2014 that was very highly leveraged and so dependent on oil prices remaining, pretty lofty, we do think that it's probably time to start rolling back some of the exposure there, especially if there is some sort of downside risk to broad-based global demand from some sort of exogenous shock that may pop up over the course of the year.
How worried are you about an exogenous shock, Matt?
I'm not overly worried about it, but pricing is certainly tight, right? So you just don't have a tremendous amount of upside. I think you're probably in a carry first environment here. As credit investors, we always have the downside, but I would say I don't think there's going to be one, but clearly it can surprise us. And given where spreads are, we have lightened up on credit just because there's a lot more ability to have downside than upside at this point.
All right, good stuff. I think we should leave it there. Matt, thank you so much. And go Team USA, Matt Brill of Invesco. Are you going to be watching the game on Sunday?
100%.
Monday. I'm sorry, Monday.
It's Monday, yes.
Live in person?
No, not in person. I've been to 6 matches, but I won't get to that one.
All right. Well, I'm sure you've seen plenty of good games. And Winnie Cisar of CreditSights. And if you can't get enough talk on credit, please check out the Bloomberg Credit Edge Weekly podcast on the terminal and wherever you get your podcasts. Now, still ahead, the World Cup underway, as Matt clearly showed us, and host cities in the U.S. got some help from the Muni market. We're going to take a closer look in our Muni moment. It's time now for a Muni moment. We go to the World Cup because municipal bonds helped 11 U.S. host cities prepare for their games. That includes securing funds for upgrading transportation hubs, renovating airports, and enhancing security. Margot Kleinman is head of municipal research and a portfolio manager at Nuveen, and she joins us now. Margot, welcome.
Hi, thank you. Nice to be here.
So your team published a report on this. Tell us about the different kinds of transportation and public infrastructure that munis helped finance across the 11 host cities. And this is infrastructure that's being used, yes, during the World Cup, but whose benefits go far beyond that.
That's absolutely right. And I think it's a great time to be here talking about this after that great win yesterday. So happy to be here. So just taking a step back, you're right. The projects that municipalities financed with muni bonds in advance of the World Cup were really part of a larger comprehensive capital plan. So as investors, we see the World Cup as an accelerator for these projects that communities wanted to undertake and now had a real catalyst to do so. So some examples are, if we look at Boston, the MBTA. So they built a new, larger platform outside of Gillette Stadium to accommodate all of the increased ridership that they're seeing to go to the games there. Or if we turn to Seattle, Sound Transit was able to complete a new rail extension over Lake Washington to connect the eastern suburbs with downtown Seattle, also benefiting visitors that will be attending those games. So you can see that these are not one-off projects that will just be used for the World Cup and then will lay dormant or be vacant and never used again. These are projects that are well integrated into these cities' capital plans. And as investors, this gives us a lot of comfort because we are really looking at the fiscal responsibility here.
So you point out in your research that none of the host cities have had to take on significant new debt to finance brand new stadiums. Does it follow then that cities like Chicago, which declined to host the World Cup because it didn't want to deal with the financial costs, did they make the right decision, or did they miss out on an opportunity to upgrade their own infrastructure?
You know, the way that we look at it is that the host cities are really leveraging some federal funding that they've received, in addition to muni bonds, in addition to some other funds, to really upgrade infrastructure. So if you look at Houston, for example, that's a city where they have a great demand for international travel. They upgraded their airport, expanded the international terminal to be able to accommodate World Cup visitors and also to accommodate international visitors into the future. And so when we're looking at it, we're really seeing it not as a big sort of borrowing or, you know, debt boom, as you said, but really something that has been well integrated, well thought out, and planned out by the host cities across the country.
So do you think Chicago made the right decision here or the wrong decision?
I think for Chicago, you know, I think that was a very individual decision for the city of Chicago. But I think when we look across, as investors, we feel really confident in the cities that did choose to host the World Cup and did choose to embark on these prudent capital projects, because I think it's indicative of the way that they are looking at their comprehensive capital plans and budgets.
You mentioned that they can leverage federal funding. What do we know about who got how much from the federal government in order to prepare for the World Cup?
Yeah, so the host cities received varying amounts of federal funding. There was some FEMA funding that was made available. There were some TIFIA loans that were made available for construction, but the federal funding really covered a small portion of the overall cost. And so cities were really looking to the muni bond market to fill some of those gaps in order to prepare for these large events.
And these are tax-exempt muni bonds as well as taxable muni bonds?
Mostly tax-exempt muni bonds. We did see, in the case of the Houston airport, issuing some AMT bonds, but mostly tax-exempt municipal bonds.
So is this theme, infrastructure upgrades tied to the World Cup but not limited to it, funded by muni bonds, tax-exempt muni bonds, something that investors actively look to invest around? I'm curious whether this is something they came to Nuveen to ask you about.
So, you know, when they were looking at the market, the cities are really looking at this, again, as part of sort of comprehensive capital planning. They're not necessarily looking at it as World Cup projects, so to speak. I do think that given the popularity of the World Cup, given the attention of the World Cup, this is giving investors another lens to really look at these cities and to bring attention to the way that cities across the country are financing these critical infrastructure projects. So I think it's an interesting angle for investors to view the muni bond market.
How do the cities kind of build on this positive momentum?
You know, I think that right now there's such positive feelings about the World Cup across the country. It's been so exciting to see the games. I think that as investors, when we see cities that are putting muni bond dollars to work in a prudent fashion, when they are accessing the muni bond market via different security pledges like GO pledges or dedicated sales tax pledges or hotel occupancy taxes, I think this really gives investors an opportunity to see the breadth and depth of the bonds and the types of securities offered in the muni market.
Very well said. Thank you so much, Margot. Really fantastic to get your take. Margot Kleinman of Nuveen. Still ahead on Bloomberg Real Yield, my final thoughts. Fed Chair Kevin Warsh reaffirms his commitment to limiting forward guidance from the central bank. What does that mean for things like the dot plot? This is Real Yield.
At my press conference, I said, I'm not going to give forward guidance because we're meeting in 6 weeks, but I have an update for you. We're meeting in 4 weeks. I want us to have a good family fight when we meet. There's a lot of late-breaking news on a series of these things. And when we get into that room and shut the door, we're going to have a good debate, but I don't have much more for you than that.
That was Fed Chair Kevin Warsh speaking in Sintra, Portugal, about changes to the central bank's reaction function. This idea that there's going to be less forward guidance, less communication, which takes me to my final thought with Bloomberg's Michael McKee. So, Michael, when you think about this idea of a less communicative Fed, not only does it mean fewer public speeches by Fed officials, perhaps, but also just less information dispersed to investors. You know, the statement of economic projections, the dot plot, is all of that at risk?
Well, there's a lot at risk in terms of the way they have been doing things, but I'm not sure they can cut back a whole lot on communications. The Fed Bank presidents represent 12 districts, and they want to talk to their constituents in those districts who want to hear from them. So I suspect they'll continue to do speeches. Maybe he can get them to dial back a little bit on the I think we're going to do this or I think we're going to do that. But really, most of them don't do that. I mean, you've interviewed enough of them. They come out and they say, well, I'd like to wait till the meeting. I want to get the latest data.
But here's what I see
But here's what I see. Now, the summary of economic projections, nobody's been thrilled with it, but they do think it's important to put out some sort of grounding for why they're doing what they're doing. So that might get tweaked somehow. The dot plot sounds like, from his comments the other day, that's gone. He doesn't like that at all. And not everybody at the Fed really likes it. So that could disappear, but they're going to have a task force to determine what they're going to do for the next communications.
And of course, this is our function on the Bloomberg terminal, dots, DOTS. I mean, this could all be for naught later on if they do get rid of the dot plot. In terms of communication, there are some federally mandated communications that he has to do, like the Humphrey Hawkins testimony, and I believe that's scheduled for mid-July. Yeah, July 14th, before the House Financial Services Committee. Don't have a date yet necessarily for the Senate, but it should follow in a day or so. First day is what really matters, but it'll get a lot of attention this time because it's going to be Kevin Warsh's first time. And what happened was we used to have very long opening statements from Alan Greenspan and people, Ben Bernanke, who would explain everything that had been going on. And then Jay Powell got back to just saying, well, you know, inflation went down and unemployment went down, and now I'll take your questions. So it's going to be interesting to see how Warsh handles the whole thing. And just remind us here of, there was broad bipartisan support to get him confirmed as the Fed chair? No, he was the closest vote ever in the Senate to get his. Because of concerns that he'd be a sock puppet, but he has shown that he is going to make the call as he sees it. That's what he's been telling everybody, and so we'll see as the time goes on. The markets are going to give him a little bit of the benefit of the doubt because he's been very strong on that. We'll see if he continues to do it and if there's anything that gives people pause. All right, Michael McKee, thank you so much. From New York, that does it from us. Have a wonderful 4th of July weekend here in the U.S. This was Bloomberg Real Yield.